Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about National Energy Services Reunited Corp. Annual Report. National Energy Services Reunited Corp. offers a wide range of oilfield services across the Middle East and North Africa region. The company's production services segment provides various essential services including hydraulic fracturing, coiled tubing, stimulation and pumping, cementing, nitrogen services, filtration, pipeline and industrial services, production assurance chemicals, artificial lift services, and surface and subsurface safety systems. The drilling and evaluation services segment offers drilling and workover rigs, integrated services, fishing and remediation solutions, directional and turbines drilling, drilling fluid systems, wireline logging, slickline services, well testing services, drilling tools, machine shop services, oilfield solutions for through tubing intervention, tubular running services, and a range of wellhead products. The company's comprehensive services cater to various aspects of the oil and gas industry, including production, drilling, and evaluation. Its expertise in providing integrated production management projects, engineering capabilities, manufacturing capacity, and testing facilities further solidifies its position as a leading provider of oilfield services in the region. The stock price of National Energy Services Reunited Corp. (NESR) has skyrocketed by over 177.39% in the past year, driven by a series of positive news events and strong financial performance. One key factor contributing to this surge is NESR's major contract wins, particularly its multi-billion-dollar unconventional contract with Saudi Aramco. This deal not only solidified NESR's position in the market, but also provided a significant revenue boost. NESR's robust fourth quarter 2025 financial results further fueled the stock price increase. The company reported an adjusted EPS of $0.32, surpassing estimates by $0.07, and revenue surged by 34.9% sequentially and 15.9% year-over-year. This strong performance was driven by NESR's strategic market positioning and growth outlook, which has enabled the company to maintain a strong position in key MENA markets. The company's focus on sustainability and digital initiatives has also opened new high-growth opportunities, while increased capital expenditures have expanded its fleet and equipment in key regions. Regional developments such as ADNOC's $150 billion oil and gas investment plan for 2026-2030 and a surge in activity in Libya are expected to sustain NESR's growth trajectory, further contributing to the company's stock price increase. National Energy Services Reunited Corp. Maintains a market capitalization of $2 billion, broadly in line with the industry peer group. National Energy Services Reunited Corp. Trades at a higher price-to-earnings ratio of 40 times and a higher price-to-book ratio of 2.17 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of various factors. On the growth side, technology enhancements and expansions in drilling and evaluation services have contributed significantly to revenue increases. Capital expenditures have also played a crucial role, with $316.8 million invested over 3 years to support revenue growth. Additionally, increased business activity in Saudi Arabia and Kuwait, as well as higher contributions from advanced directional drilling technologies, have driven revenue up. In the MENA region, revenue has grown by 15% between 2023 and 2025, while the Drilling and Evaluation Services segment has seen a remarkable 74% increase. The Production Services segment has also experienced growth, with a 32% rise in revenue. Furthermore, an increase in unbilled revenue, a decrease in accounts receivable, net, and an increase in other current assets have all contributed to revenue growth. On the decline side, revenue has decreased by 4.2% in the MENA region between 2023 and 2024, and by 11.3% from 2024 to 2025. The Production Services segment has seen a decrease of $62,077, while rest of world revenue has plummeted by 57%. These declines can be attributed to various factors, including decreased business activity in certain regions and the impact of asset purchases on revenue. It is worth noting that acquisitions have played a significant role in driving revenue growth. The acquisition of NPS/GES Business Combination, SAPESCO, Action Energy Company WLL, and minority stake investment in WDVGE have all contributed to increased revenue. However, these acquisitions have also led to decreased revenue in certain segments, highlighting the complex nature of revenue drivers. Net income and profit margins experienced significant fluctuations between 2023 and 2025. Initially, net income increased from $12.6 million in 2023 to $76.3 million in 2024, a substantial growth of 506%. However, this trend reversed in 2025, with net income decreasing by 33% to $51,132. Profit margins also underwent changes during the same period. The gross profit margin increased from 13% in 2023 to 16% in 2024, but then decreased to 12.4% in 2025. Operating income margin followed a similar pattern, decreasing from 11% in 2023 to 10.6% in 2024, and further to 7.2% in 2025. The reasons behind these changes are multifaceted. Reduced hydraulic fracturing stages upon contract transition and decreased coiled tubing activity in Saudi Arabia contributed to the decline in net income and profit margins. However, higher specialty chemical sales in Egypt partially offset these losses. Additionally, impairment charges related to investments in IPM projects also negatively impacted net income and profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. Over the past 3 years, the net cash provided by operating activities has consistently increased, indicating a growing trend of profitability. In 2025, the company generated a significant amount of $264,242 in net cash from operating activities, showcasing its strong financial health. This is an increase of $34,913 from the previous year's figure of $229,329. Furthermore, when compared to 2023, the company has seen a substantial growth of $87,283. These numbers demonstrate that the company is not only generating positive operating cash flow, but also experiencing a steady improvement in its financial performance over time. This trend suggests that the company is well-positioned for future success and continued growth. The company's debt level has undergone significant changes between 2024 and 2025. According to the financial reports, the total debt outstanding decreased by $72.7 million from 2024 to 2025, with a notable decrease in long-term debt from $323,122 in 2024 to $255,878 in 2025. The utilization of working capital facilities also saw an increase from $226.6 million in 2024 to $243.8 million in 2025. The reduction in debt levels has had a direct impact on the company's interest expenses. Interest expense, net decreased by $7.4 million from $39.9 million in 2024 to $32.5 million in 2025. This decrease is attributed to lower debt levels during the year ended December 31, 2025, resulting in reduced interest payments. Overall, the company's efforts to manage its debt have led to a significant reduction in both debt levels and interest expenses. The performance of various segments and regions was notable in the recent period. The MENA region stood out as a top performer, achieving significant growth in revenue by 2025, reaching $1,315,939. In terms of specific segments, production services demonstrated a strong performance, with revenue increasing steadily from $674,582 in 2023 to $715,681 in 2024, and further to $731,207 in 2025. On the other hand, drilling and evaluation services segment struggled, experiencing a decline in revenue from $438,993 in 2025 to $360,526 in 2024. These results indicate that certain regions and segments are outperforming others, with the MENA region and production services being notable examples of success. Management is optimistic about the company's outlook, citing several key strategies to drive growth. The primary focus is on decarbonizing operations and improving water stewardship in the upstream value chain. To achieve this, the company plans to deploy advanced directional drilling technology and continue investing in equipment to support revenue growth. A low-risk, capital-light approach will be taken for investments and development projects, particularly in the Middle East and North Africa region. The company aims to expand its operations in these countries, focusing on upstream and midstream oilfield services with customers in the oil and natural gas industry. Management also acknowledges potential risks and challenges, including increasing financial risks for fossil fuel companies and reduced demand due to stricter regulations. However, the overall strategy appears to be centered around investing in research and development activities, streamlining technology commercialization, and expanding its presence in key regions. The company has made several significant acquisitions and investments in its operations. One notable acquisition is the purchase of NPS, although specific details regarding this transaction are not provided. Additionally, the company has invested heavily in property, plant, and equipment, with expenditures totaling $36.3 million in 2024 and $17.6 million in 2023. In terms of divestitures, there have been no notable transactions mentioned in the extracted summaries. This suggests that the company is focused on expanding its operations through acquisitions rather than selling off assets. The company's financial activities have been transparent in their annual reports. One notable aspect is the absence of dividend payments. According to the reports, there has been no approved plan to pay cash dividends on ordinary shares, page 21, page 37, and page 42. This indicates that shareholders have not received any direct returns through dividend distributions. On the other hand, the company has engaged in share buybacks. Specifically, warrants were exchanged for ordinary shares on July 1, 2025, page 96. This action effectively reduced the number of outstanding shares, which can positively impact earnings per share and boost investor confidence. Concerns about supply chain disruption are valid due to various external factors. Civil unrest, acts of terrorism, government actions, and other unforeseen events can cause disruptions, page 24. The Middle East region is particularly vulnerable to supply chain disruptions, with potential delays or rerouting of oil and gas cargoes, increased shipping costs, and damage to energy infrastructure, page 25. Furthermore, suppliers' delays in meeting their obligations could lead to contractual delays, adding to the overall risk of supply chain disruption. However, there are no significant concerns about inventory buildup, indicating that the primary concern lies with the potential disruptions rather than an accumulation of excess stock. That concludes the financial summary for National Energy Services Reunited Corp. Feel free to comment below, and I will be happy to answer them when possible.